Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, hello and welcome to Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me, Rima as well as Mangalam. Well, morning, guys. Markets have been looking up. Festive cheer is coming in. And hopefully, Mr. Trump as well wants to celebrate Diwali with his Indian brethren.
Let's see how that goes, Nigel. There is some cheer, and the proof of that will also come from the numbers today. We have Nestle, which is reporting numbers. More than just the numbers, the commentary will be extremely crucial. The other one is Eternal. That reports its numbers as well. From the last time to now, the stock has seen a big rally, now at a record high. What do they have to say of quick commerce competition and demand in the food delivery space? Very, very crucial.
So in the thick of the earnings season, it started with IT. We got Axis Bank yesterday, and today we'll get a flavor of what the consumption trends are going to look like. But let's take it right from the top in terms of the Wall Street action. Now, Wall Street ended mixed, but we came off from the day's high. So the Dow, by the end of it, slipped into the red, closed pretty much flat. But at one point of time, the Dow was up nearly about 450 points. The S&P 500, NASDAQ, it closed in the green, a gain of about 0.5%. But again, as you can see, all these came off from the highs. But despite the late fade, banking stocks in the US were shining. So Morgan Stanley surged close to about 6.5%, hitting a record high. Bank of America jumped close to about 5.2%, a 52-week high on that. And this is on the back of strong quarterly results. But I think the big story that's relevant for India once again is Donald Trump and what he has to say. And this time, it doesn't come via a tweet. This was at a press conference when he was asked by a reporter. So in fact, let's play out that bite for the benefit of our viewers, and then we'll get to it.
Great relationship. He just said that 2 days ago, as you know. We have a great relationship. No, we were not happy with him buying oil from Russia, because that lets Russia continue on with this ridiculous war where they've lost 1.5 million people, by the way. Russia's lost 1.5 million people, soldiers mostly. This is a war that should have never started, but it's a war that Russia should have won in the first week, and they're going into the 4th year. And I want to see it stop. So I was not happy that India was buying oil. And he assured me today that they will not be buying oil from Russia. That's a big stop. Who would think I created peace in the Middle East and can't get the two guys to settle? But I think we'll get them. But if India doesn't buy oil, it makes it much easier. And they're not going to buy. They assured me they will. Within a short period of time, they will not be buying oil from Russia. And they'll go back to Russia after the war's over.
Well, that is the big headline, right? Donald Trump claiming that Prime Minister Modi has assured him that India will not buy oil from Russia. As you heard, he called India a great country, Modi a great friend, but he also suggested that India could resume purchases from oil once the war ends, because this process takes time. But, I think, we'll have to wait for what the administration, the Indian administration has to report. And what this means for India, because not buying the cheaper Russian oil is not good economically. It doesn't bode well for India's energy security. But if that means that at least Trump's penal tariffs get listed, then perhaps you could read it positively as well. But as I said, we'll wait for the official response from the Indian government. Meanwhile, the dollar index is now sub 99. I think it's closer to 98.5. And the run-up, the record run-up in gold and silver extends itself. Gold has crossed $4,200 an ounce, and we'll get to Manisha on that. But, after the Wall Street action, let's just quickly pull up Asia. Asia is broadly okay. The GIFT Nifty is also suggesting a slightly positive start. So that's continuing with the momentum from yesterday when markets recovered and snapped that 2-day losing streak. So what will you quickly watch today? It's the weekly expiry for the sensex future. Big day on the earnings front. So you'll cap off the IT earnings. You've got names like an Infosys, Cyient, LTI, Mindtree reporting numbers. And on the consumption side, it's Nestle and Eternal. So keep your eye out on these names. Plus the listings of Canara, Robeco and Rubicon Research should be on your radar. So all in all, it's going to be a packed Thursday lineup, earnings, expiry action. But Nigel, what about levels in the the F&O action.
Well, that's right. We don't want those FIs to turn sellers. And if they're not sellers, it's good. If they can be mild buyers, well, that's a bonus as well that comes in. And yesterday's trading session, the FIs, after selling a little bit in the last couple of trading sessions from a negative number of around 1,500 crores, they at least delivered a positive number. We want them to be part of this, and hopefully we have a party here on Dalal Street after very, very long, after underperforming. So the FIs, they turned buyers. What else did they do? Well, I was looking at the future space, and out there, well, there was mild covering, both on stock futures as well as on index futures. So that is good news, and we've been talking about this. When their short positioning on the index gets to extreme levels, that calls for some bit of covering. But keep in mind, they're still very much net short, close to 1.89 lakh contracts on the short side from the FI short positionings on index futures, and in percentage terms, 92%. So did we just get a demo yesterday of more of what is to come from here on? Well, time will tell on that front, but with them short at 92%, that's giving a bit of a cushion as well. Moving to the options data then, well, we have the 25,500 call. Saw some bit of an action, but now you see that the bulls are getting a little bit more confident because writing has moved up. 25,000, 25,100, 25,200. And yesterday we saw some signs at around 25,300 put as well. So punching in the options data and the technical levels as well, I think you have two reference points now. On the downside, that 20 DMA, around 25,070 or 25,000, that's the round number that you're looking at. On the downside, that's the first reference point. Till that level holds, you'll be optimistic that the markets can climb the wall of worry. And on the upside, the recent high, that 25,450 around 25,500, going by the options rate as well, that could be a bit of a congestion zone. And keep in mind now, there's some positive comments coming in from President Trump, which will help sentiment on the whole, and that could be the big driver. Moving to stocks that will be in focus as well. Well, RBL Bank. Yesterday in the morning chart, I had mentioned this, that there's a possibility that it comes out of the F&O ban because the shorts are getting a little bit nervous, going by the kind of news flow that you've seen. And the last 3 months, most of the period, they have been in the F&O ban. So that's a stock that will continue to be on the radar. Now it comes out of the F&O ban. And from the results, MRPL came out with a very, very good set of numbers. The GRMs have improved out there. So we'll see how that goes. Even they reduced some debt out there. But since the refining margins have improved, the direct stock that you look at is Chennai Petro. So we'll see whether or not there is some rub-off on this particular name. And the OMCs as well, namely BPCL, because they get a lot of their profitability from the refining side of things. So we'll keep an eye out on this. And some part of Reliance business as well will be attributed to refining. So MRPL coming out with this set of numbers, stock will be in focus, and maybe a positive rub-off on some of these other names.
All right, Nigel, thanks a lot for that. That will be the setup for the day when it comes to the global markets as well as the F&O setup, the Nifty in that 25,000 to 25,450 sort of range. Good time to bring in James Knightley, who's the Chief International Economist, joining in from ING. Thanks a lot, James, for joining in. There is so much back and forth that takes place from, Donald Trump. What do you make of the latest comments, and how much weightage would you add to that? Could there finally be some trade deal that would come by between India as well as the US?
Yeah, I mean, it's as we've realised with Donald Trump, nothing is ever set in stone, and things are always capable of moving. China was in the headlines on Friday. Today, it's India as well. So, things can constantly move. Hopefully, there is an agreement, and that can be mutually beneficial and positive for growth on both sides.
James, hi, morning. This is Rima here. Or is it night for you?
It is nice, yes.
It's nice. So thank you very much for joining us. So the next FOMC meet is 29th October. Now, considering that the US government shutdown has extended itself into the third week and we're not getting any economic data points, what does this mean for expectations of a rate cut from the Fed in the October meeting?
Yeah, as you say, the government shutdown, one of the big fallouts from that is that most of the statisticians have been sent home. They're not receiving pay either at the moment, so they're being furloughed. So we do have big gaps in our knowledge as to what's going on. So we're having to fill those gaps with private sector surveys. But also, we've got to remember that the Federal Reserve themselves are not subject to the government shutdown. They are separately funded. And they still are producing data. And we had that my time today from the Beige Book. And this is an anecdotal survey of the state of the US economy. And it's really, really important. The Fed puts a lot of weight on this because they themselves collate it. They go around asking trusted contacts what's going on in the US economy. So employers' federations, trade federations, companies, and trade unions, all those sorts of things. So they've got a pretty good idea of what's going on. And unfortunately, it wasn't particularly good today. There was indications of more loss of economic momentum, more weakness in the jobs market as well. And following on from Jay Powell's speech yesterday in Philadelphia, where he suggested there's no sign of real improvement since the last FOMC meeting in September. And at that meeting, they themselves were forecasting 2 more rate cuts this year. I think there is still enough evidence out there, even though with the government shutdown, even with the lack of official data, to trigger another rate cut in October. And we think also another rate cut in December as well.
Okay, all right. Hi, James. Morning. Always good to speak to you. How are you reading the U.S. economy, though? One would have thought they would be in a little bit of trouble with the kind of global uncertainty with regard to what Trump has to say and those tariffs as well. But it appears earnings are pretty okay out there. And the economy as well keeps climbing any kind of wall of worry, so to call it. Your reading of the U.S. economy?
Yeah, so at the moment, I think pretty much everyone is looking for these 2 rate cuts this year in October and December. The Fed are forecasting it, the markets are pricing it, economists are also saying that that's what they believe. But for next year, it's a little bit more diverse in terms of the thinking out there. Now, the positive spin on the US economy is that, well, looser financial conditions from Fed rate cuts, lower treasury yields, a weaker dollar, that's all pretty growth supportive. And if we do finally get clarity on trade, things settle down, that may start to boost sentiment, may start to encourage companies that have been a little bit anxious to start putting money to work. Starting to invest, starting to hire once again. And that would mean perhaps the Fed don't need to do all that much more and the economy can recover quite nicely. But there is a negative scenario as well, whereby the trade tariffs do start to bite. We do see squeezed spending power in America. We do see squeezed corporate profit margins in America. And at the same time, we've got to acknowledge that the jobs market is weakening. That momentum could continue for another few months or so. And that really undermines consumer confidence. And in the United States, consumer spending is 70% of economic activity. And then thirdly, the other risk is the housing market. We have seen 5 consecutive monthly price falls in property prices. And that's another important store of household wealth. And that could yet undermine that growth story. So you're getting a diverse range of views. You're getting the upbeat view where we may only need 1 more rate cut next year. But there's also a downbeat scenario where we could see the Fed need to move into stimulative territory and actually cut rates perhaps 100 basis points next year. So you are seeing that sort of split. We're somewhere in the middle. We're cautiously optimistic, but we do think it's probably going to take it more than 1 rate cut to turn things around. We think we are looking for 2 this year and at least another 2 rate cuts next year.
All right, James, no conversation is complete nowadays without talking about the view on gold. And we focus on the equity markets, but the big move really has come, both on gold as well as Bitcoin. And one would have thought, the investors approaching both these 2 asset classes are very, very different. But how do you read gold going ahead? 50% up in a single year. Has it run its course? Or do you think central bank buying, ETF flows as well picking up, and those rate cuts as well normally bode well? Your view on gold?
Yeah, I mean, you can look at most risk asset classes and you could say, well, they've had a fantastic run. Are they in line with economic fundamentals or are they becoming somewhat detached? I'm going to have to stick with the Economists Union and quote John Maynard Keynes at you and say, markets can remain irrational longer than I can remain solvent. Yeah, it certainly could go higher. And there's at the moment very little to trigger something that might lead that to correct, even if you do fundamentally think, well, we've had a long run, can this really continue? We're in these sorts of frothy markets right now where anything could happen. And I do get a sense that volatility is something that is really going to be picking up as the risk environment evolves over coming months.
So amidst all of this, what would your view on some of the emerging markets be? And given the underperformance of India, would you see that turning at any point in the very near future?
I think we need a bit more clarity, don't we? And, if we can get trade situation resolved and the energy situation in India resolved as well, a mutually beneficial deal, then that can be a platform for opportunity and a platform for growth. But as long as there's uncertainty, there's always going to be these nagging doubts about what's out there, and that just makes consumers and businesses cautious. So a bit more clarity on where we're heading, and that can actually allow a bit of stabilisation and room for improvement in an environment where we have got looser financial conditions, as I already mentioned.
James, great chatting with you. Thank you very much for joining us. Moving on now, we've got an action-packed show, so let's quickly tell you all the interactions that we've lined up for you today. So coming up at 8:35, we have Dinesh Khara, former chairman at State Bank of India, joining us as sources tell us that Emirates NBD is eyeing the acquisition of a 60% stake in RBL Bank via a fresh equity issuance to its wholly owned subsidiary. 9 a.m., Parag Thakur of Ford Capital will join in to talk about the markets and Axis Bank's Q2 earnings. At 9:20, Gautam Chocharia of UBS will be our market master for the day. 9:30 a.m., the management of IRFC, Indian Railway Finance Corporation, will join in to talk about the Q2 numbers. Following that, Vibha Padalkar of HDFC Life Insurance will be chatting with us at 9:40. And at 9:50, the management of KEI Industry will talk about the outlook for FY26. And towards the end of our show, in our special segment, It's the Economy, Lata will chat with Saugato Bhattacharya of Centre for Policy Research on the key takeaways from the MPC Minutes.
Time to slip into a quick break, but we've got a lot of stock-specific action to track for you on the other side. We get to that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek. RBL Bank, HDFC Life, KEI, Angel One, MRPL, and Rosari Biotech. They'll all be reacting to positive news flow, while we have HDB Financial Services and Oberoi Realty that will be reacting to negative news flow, while we could expect a mixed start on Axis Bank and L&T Finance. Slip into that break, come back, we get into further detail on all of these names.
Welcome back. It's time to talk stocks now. Our entire research team is standing by with CNBC TV18's list of top stocks for the day. Good morning, guys, and let's take it with Axis Bank. Gaurav, how did the numbers look?
Well, if you look at Axis Bank's numbers, operationally it was good, but there was a one-off impact of 1,200 crores. That is actually something which actually costed Axis Bank's profit to fall almost by 26%. So let's go to what actually went right. When we look at loan book, that actually was strong at around 11.7%. Remember, for the last 3 quarters, Axis Bank has been reporting weaker loan book growth. At the same time, management is still optimistic to achieve the loan book growth over and above the industry of around 300 basis points. Net interest margins, that was another area where they surprised positively, because that came in at around 3.73% versus street's expectation of 3.63%. And this was because of the efficient liability repricing. And they also believe that in next quarter, we will see the bottom of NIMs. Third is that when we look at gross slippages on technical impact, now that declined almost by 44% on a sequential basis in absolute terms. And even if you look at the ratios, gross slippages, net slippages, even credit cost, that has gone down sequentially on a healthy basis. What was actually a hiccup is that there was one-off impact of 1,231 crores, and this was directed by RBI because of one of the crop loan variant account, and that is the reason why, if you look at profit, that declined almost by 26%. Now, although management is saying that there won't be any one-offs further, and at the same time, this provision of 1,231 crores will be written back completely by the end of FY28. We will definitely watching out on how market reacts and how investors are going to take this one-off impact specifically in this quarter and for the quarters going ahead.
All right, take that point. Thanks a lot for that. Let's go to Sonal now. Sonal, Oberoi Realty, how's the stock likely to be today?
Well, for Oberoi Realty, like other real estate companies this time around, the real estate or the residential update hasn't been so positive. On a quarter-on-quarter basis, there has been a fall in sales at 1,300 crore rupees. The volumes also have come in lower at 0.25 million square feet. It's the existing sustenance projects which have led to the sales that we've seen this time around. Elysian and 360 West have driven sales this quarter. The company says it was led by existing projects, the sales that came by this time around as well. Occupancy in commercial portfolio improved both in the office space and the retail space. The P&L is strong, but of course it's lumpy accounting, but going with red because of the decline that we've seen in sales on a quarter-on-quarter basis.
Okay. All right, Sonal. Thanks a lot for that. Well, let's go across to Ritu. She joined in yesterday. She gave us that big break. And it appears directionally it's moving in that direction. Morning, Ritu. Tell us more.
Morning, Nigel. Yesterday we were talking about how we may finally hear of that much talked about RBL Bank Emirates NBD deal by Saturday, which is when the bank is going to be announcing its earnings. And now, the bank has sort of made the first step. It has announced that its board is going to be meeting on the 18th, the same day as the financial results, to consider a fundraising, by issuance of share, either through a pref issue or a private placement. And that we understand, of course, is the first step, to bank really considering this majority acquisition by Emirates NBD. As we've been reporting, the Dubai-based lenders looking to acquire as much as 60% stake in RBL Bank with a massive capital infusion. The transaction pricing, however, as we've been reporting, is unlikely to be at any significant premium to the current market price. That said, of course, RBL Bank has been running up in trade. All of this year actually has been one of the best performing banking stocks. The excitement clearly coming in from, this deal finally fructifying, and we may hear more come this Saturday.
Thank you very much for that. 18th October, the board meet for fundraising. Back to earnings then. KEI Industry and Angel One. Ria, how did they look?
Well, yes, good set for KEI Industries this time around, largely inline set of numbers. In fact, revenue growth was driven by the key cables and wire segment, which saw healthy domestic demand as well as a rise in copper prices. The growth this time around was primarily led by LT and EHV cables as well as house wires. The cables revenue grew by 23% on a year-on-year basis, while EPC fell by around 6% and SS wires fell by 10% when compared to Q2 of last year. The H1 revenue growth stood at over 22%, and this compared to an 18 to 19% full-year growth guidance that was given in Q1. And the order book of the company is also at 3,842 crores. So good set for KEI. Moving on to Angel One, the revenue was slightly below estimates, while net profit was largely in line with estimates. Revenue went up by around 5% sequentially, while net profit saw an increase of around 10% compared to the previous quarter. The average daily turnover of the company went up by around 31.8% sequentially as well. And the company has also seen growth in market share across all verticals, with the commodities share growing to around 65%. The average client funding book of the company also went up by roughly 26% on a sequential basis. So positive start expected for both of these companies today.
All right, positive start expected for both of these companies. How would you read MRPL and Rosary Biotech's numbers, Sonal?
Well, both of them good set of numbers this time around. For Rosary, it was a good growth in revenues, up 17.6%. EBITDA was up 9%. There was some margin compression, but and that led to profits also going lower in terms of growth, so 4.5% in terms of profit growth. But the management maintains their guidance for FY26 growth. Additionally, the board has approved additional investment of $8 million in wholly owned subsidiary, which is Rosary International. For MRPL, after a loss-making quarter, they have seen a recovery because of better diesel and petrol cracks, and that is seen in the PNL as well. Revenue growth of 27%, EBITDA 140%. Margins have doubled on a quarter-on-quarter basis, and it's a profit this time around versus loss last time. But the company has not given any details on GRMs, but the PNL looks strong this time.
Okay, all right. Thanks a lot for that, Sonal, and take care of that throat. If not, when you reach office, Mangalam is planning a nice hot cup of coffee for you. For now, we'll hop across to Yash, though. Yash, tell us about HDFC Life.
Well, for HDFC Life, I'm going with mild green, and that's because the numbers have largely been in line, with an exception to margins which have beat CNBC-TV18 estimates. So as far as the new business premium is concerned, that has slightly missed CNBC-TV18 poll. On a year-on-year basis, it's grown by about 10%. Total annualized premium equivalent, again, in line with CNBC-TV18 poll, growing at about 8.5% on a year-on-year basis. Retail business, that has also come in line with CNBC-TV18 poll. On a year-on-year basis, that particular counter has grown by 9%. Now, VNB has come in line, growing at 7% on a year-on-year basis. And as I said, a slight beat has come as far as margins are concerned, but it still is down about 21 basis points on a year-on-year basis. The number that has come in on VNB margin is 24.09% versus 24.2% on a year-on-year basis. The reason why I'm going with a mild green is because of the slight beat on the margins, and stock hasn't done much in the last 3 months. In the last 1 month, the stock has been flat. So these two reasons why I'm going with a mild green.
All right, take that point, and we'll be speaking to the management as well. Trust you to send us some, important questions that the analysts would want to know from HDFC Life as well. With that, We'll go across to HDB Financial and L&T Finance. Gaurav joins in for more.
Well, yes, when we look at HDB Financial, net interest income, that was in line. In fact, net interest margins, that expanded almost by 20 basis points. But what happened is that the credit cost, now that has gone up almost by 20 basis points. And remember, this is one of the highest levels that we have seen since COVID-19. So definitely, that is an area of concern. What management is saying is that the stress in CV is the reason why we saw credit costs inching up. But at the same time, they believe they will be achieving 2.2% credit cost in the medium term. Apart from that, when we look at loan book growth, not a great show. In fact, disbursements, they were flat on a year-on-year basis. So definitely going with red for this. Other than that, L&T Finance. Now, when we look at numbers, net interest margins that expanded almost by 18 basis points. In fact, net interest income increased almost by 8% on a year-on-year basis. When we look at credit costs, that inched up only by 18 basis points. And the reason being that they have utilized 150 crores worth of macro-prudential provisions once again. Now they are left with 125 crores of such provisions. Management, if we exclude this macro-prudential provisions, the credit cost comes at around 3%. When we look at profit, that increased just by 6%. It was a little lower than the street's expectation, but the call is scheduled on at 11 o'clock today. So definitely we'll be watching out on how the commentary is going to be from management on the way going ahead, and at the same time on ROAs, because they are still behind their 2.8 to 3% target that they had given for ROAs. So definitely watching out at this talk today.
Thank you very much for that. Lots of stocks to keep on your radar. Let's do a quick recap then. Stocks with positive news flow are RBL Bank, HDFC Life Insurance, KEI Industry, Angel One, MRPL and Rossari Biotech. Stock with negative news flow are HDB Financial Services, Oberoi Realty. While mixed views coming in on Axis Bank and L&T Finance. Well, here's a quick note for all our viewers. As you would have seen on the screen, there is a money control stock score just above the line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, include both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameters considered for the calculation of the 4 factors, and they're assigned a score, which is then aggregated to arrive at an overall Q-factor score, G-factor score, V-factor score, and a T-factor score. But remember that this is not a buy or a sell recommendation. Any investor viewer is advised to carry out their necessary diligence on their own or through a certified, registered financial advisor for their investment decisions.
Okay, all right. Well, let's hop across to Manisha Gupta, who joins us for a complete roundup of what's going on in the commodity market. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll keep it to precious metals because this is an area that continues to buzz very strong. We have gold prices now hitting all-time highs above $40 to $30 an ounce. So the Indian markets, which will open very shortly, which will be an all-time high for India as well yet again. Well, Powell at NAB annual meeting has talked about slowdown in hiring that is increasingly threatening the U.S. economy. That's all the gold bulls wanted to hear, and you have those premiums building in yet again. And then the street is now betting on 2 rate cuts of 25 basis points each in 2025, also supporting markets. It continues to be the U.S.-China trade tensions, ongoing U.S. government shutdown, demand from India as well, which continues to support not just the gold prices, but silver as well, which has gained 3% overnight. It's trading at an all-time highs above $53.50 an ounce. Well, the global supply crunch is fueling this historical rally, and you have the silver prices up by nearly 84% in this year itself. The supports have continued for metal markets as well. You have copper, which is rebounded yet again in the overnight market, gained up by 1.5%. Silver was trading in the positive as well. Platinum is trading at 12.5-year highs. The only thing that's not doing so well has been the crude oil prices, as the markets are looking at a rise in U.S. crude inventories for a third straight week.
Extraordinary, the kind of run-up we've seen in precious metals, getting a bit too precious now for purchases. Dhanteras is on Saturday, so Manisha, we'll keep coming to you to find out what the situation on the ground is with respect to demand.
She'll be on the ground and she's going to the
Zaveri
Bazaar Gems and Jewelry Festival, which is taking place right now, and it's pretty close to my house, and the way they've done it up this time around is incredible. They've lit the entire area up, and Manisha will obviously get us visuals as well, and they've made it a pedestrian-only place, and they've red-carpeted the whole place. So it's looking beautiful. Manisha, it's the entire area is like a Ganpati Mandap. Manisha, you want to come in on that one?
Oh, yeah. Absolutely. Exactly why I'm going, because today is the last day of the festival, and people in the very Bazaar tell me that even with the gold prices at where they are, it is absolutely crowded. Shops also filled in with people wanting to buy. Of course, they're coming in with their budgets and whatever they can buy at those in those prices. But yes, there is that buying happening even now. And people who are not buying are actually booking it for Dhanteras and Diwali in anticipation that you could be looking at higher prices going forward.
And a lot of people also just to get the vibe of the festival as well.
I'm sure.
And I believe, Manisha, that last twinkle is left on Zaveri Bazaar. You know how? Manisha needs to visit. So we look forward.
We've extended the festival by a day only so that Manisha could visit.
So today, it'll be twinkling a little bit more because our very own Manisha will be there. Thanks a lot, Manisha, for joining in. Well, I'll tell you what. Let's slip into that short break. You come back, we'll go full throttle on stocks. Deepan Mehta of Let's Start Equities will be joining in.
Welcome back. You're watching us here on Bazaar Morning Call. A 40-point uptick on the GIFT Nifty after a good 180-point rally on the Nifty yesterday. A bunch of stocks doing well. In fact, 1,800 stocks in the green for about 1,000 stocks in the red yesterday. Which were the big movers which saw healthy volumes? We have Hormaz with the delivery data. Hormaz.
Morning, Manglam. And Urban Company is the first one that comes to mind because it's after the big listing pop that it saw, the stock just fell off the radar and then sprung up yesterday among the list of gainers. It was the second best performance for the stock in its brief trading history since its listing day. This is the first instance after the last 9 sessions that more than 1 crore shares were traded on the stock yesterday. Well over 3 crore shares were bid for and 42 lakh of those were marked for delivery. We're mentioning this stock today as well because the 1-month shareholder lock-in period ends today, and as a result of the move that it saw yesterday, that 11% up move, the stock closed above its listing price of 162, which it had fallen below as a result of that 5-day losing streak that it had seen before yesterday's up move. PSU banks led the charge yesterday as well as continuing with their outperformance, and Bank of Maharashtra was among the top movers in that pack, almost 8% higher, the biggest single day gain in well over a year. Volumes also were the highest in well over a year. Almost 10 crore shares were traded on Bank of Maharashtra yesterday. The 20-day average here is just over a crore and almost 2.7 crore of those were marked for delivery. The 20-day average here is just around 55 lakh shares. The 2 earnings reactions that stood out yesterday, one was ICICI Lombard, the other one being Persistent Systems, both of them ending with gains of anywhere up to 9%. And look at the volumes here as well. Almost 70 lakh shares for ICICI Lombard, 35 lakh for Persistent Systems, and that is at least 10 to 15 times higher than their respective 20-day average. And you take a look at the delivery volumes as well. ICICI Lombard had almost 11 lakh shares marked for delivery. Persistent had close to 19 lakh shares marked for delivery. So strong delivery-based buying in these earnings reactions as well. And lastly, GM Breweries, we spoke about this on closing. You added to it as well. And look at the trading volumes here. And from the start of the year until the 8th of October, the average daily traded volume in GM Breweries was just 75,000 shares. It reported its results, and ever since then, the average daily traded volume has been 55 lakh shares for GM Breweries. Even yesterday, we had 1.1 crore shares that were traded on the stock. The 20-day average here is just 11 lakh shares, and this too is because of this last 3-4 days where there has been extended trading activity. And out of that 1.1 crore shares, 6.5 lakh were marked for delivery. The 20-day average here is just over a lakh. That's GM Breweries for you, up almost 60% now in the last 10 sessions.
Yes, and when you said you added to it, I meant added to it on the research side and not perhaps on the consumption side out there. But thanks a lot for that, Hormaz. Let's welcome Deepan Mehta, Director at Elixir Equities, joining in now. Deepan, your thoughts, one, on Axis Bank results, mainly because, you know, on the one hand, the operational performance was decent, but the PAT, once again, impacted by a one-off.
Yeah, good morning, Mangalangam. Thank you for having me on your show. Slight disagree with you that even the operational performance was extremely disappointing.
Okay.
Its loan growth is, which was, we are used to 15-17%, has now dropped to 10-11%, I think, which is below a lot of peer group companies, below a lot of PSU companies for that matter. There was a shrink in the NIM. I think anywhere from about 73% increase in provisions. So I'm not so sure. I think, you know, when I look at Axis Bank results just now, it reminds me of the PSU bank results we used to look at 3-4 years ago, you know. So very, very disappointed. And I think that these companies, HDFC Bank, ICICI, Axis Bank, IndusInd Bank, we need to have a strong look at these companies. What is going to be the long-term trajectory? Are they going to really be outperformers as they have been for the last 30 years? I don't know. I don't have answers to these questions, but I'm looking at those holdings very, very closely in terms of exiting them.
Okay, all right. Not too impressed with Axis. Got it. Deepan, what about Urban Company? On listing day itself, it went up dramatically. There was some follow-through buying, and it's back at around 165 rupees on. Today, there's a lock-in that opens up, so that could be could possibly be fresh supply that comes in there. What's your view on the company? We know there's a long runway. Most of us are users as well. But from an investor perspective, what's your take?
Yeah. Good morning, Nigel. See, the way I'm looking at Urban Company, and mind you, as a measure of disclosure, we have invested in that company, is to see the roadmap which has been, kind of traversed by Swiggy and by Zomato, especially Zomato and then even Paytm. Although these are different companies in different sectors, but basically these are, kind of different types of businesses, platform businesses, companies which built huge user base, subscriber base, and then now they are trying to, get into a profitable zone. And that may take some time, but end of the day, I think what happens post-listing is that these companies which were earlier PE funded now look in terms of, making adequate profit to service the new investors. I think Urban Company will go in the same way and follow the same path. And therefore, if you have a really long-term horizon, 3 years, 5 years, 10 years or so, then I'm sure Urban Company can deliver very good results, as very good returns, as we have seen the case of Eternal and even Paytm. But you should be prepared for a lot of volatility in the stock price and the earnings.
Typically, this current quarter is a very strong one for Urban Company, given the Diwali festive cleaning that takes place, the deep cleaning services. So typically, Q3 is a good quarter. So we'll await numbers as and when they come. 164 is the share price on Urban Company. The high was, I think, 201 on that. Dipan, hold on. We've got Vivek also joining in on IEX and the insider trading case. Vivek, give us the details.
Well, that's right. So yesterday, SEBI came out with a very detailed note, and they've gone ahead and taken action. So what is it that SEBI has done as far as insider trading allegations of IEX was concerned? They've taken action against 8 entities. All of these 8 entities have been directed by SEBI to go ahead and return a little over 173 crore rupees of unlawful gains. Along with that, the entities have also been restrained from dealing in securities market till the amount is impounded. To give some background, remember, July 23rd, 2025, CERC post-market hours had issued directions for implementation of market coupling, which was expected to have a negative impact as far as the share price of IEX was concerned. And along expected lines, on July 24th, the share price of IEX fell over 29%. Now, on July 23rd, SEBI noted that there was a significant decrease in the share price of IEX, coupled with very high trading volumes. And on the back of that, SEBI went ahead and duly examined the possibility of insider trading. And SEBI's analysis shortlisted certain entities who had taken positions in put options of IEX on July 23rd, one day before the 29% fall. So on the back of that, the entities managed to garner ill-gotten gains of over 173 crores. They conducted search and seizure operations from September 18th to September 20 of 2025. And SEBI also noted that these entities were regularly getting insider information from high-ranking CERC officials. Important to note, no fresh material impact on IEX shares today on the back of this particular development. And the separate case is ongoing at Aptel from IEX's, has gone ahead and asked for non-implementation of market coupling.
Very well explained, Vivek. Thanks a lot for joining in and giving us, explain to us that piece of news. Deepan, imagine, 173 crores on this single trade. IEX in an entire quarter, the organization makes 110 crores. So the single trade was actually 1.5 times what IEX's PAT was in the last quarter. That aside, let's talk about the life insurance companies. HDFC Life, we'll be talking to the management later on. Any view on that particular name?
No, Nigel, I have given up on the insurance companies. Completely candid, extremely difficult to understand the business. And look, if they had set the stock market on fire and these companies had been great value creators, outperformed the sensex nifty by a huge margin, me and many investors that have taken the trouble to understand them, and all the kind of exotic acronyms which they keep using in their financial disclosures. But look, end of the day, 5-year returns for HDFC Life have been subpar, below the Nifty returns. Same is the case with ICICI Life and also SBI Life. I think the only outlier has been Max Life. But as I said, I think there's so much of choice in the financialization of saving space that you're better off working on those ideas than insurance companies. I think they have challenges in terms of high regulatory requirements which prevent innovation, and so many assumptions also are taken. So, I mean, from an investor's perspective, they are great stocks in a turbulent market. They are safe stocks, but look, we want growth stories just now.
Okay, what about KEI? It provided that growth. You have two big players that are going to be coming in, but it seems the sector itself has a lot of growth tailwinds. Your view on the results or the read-through for the other companies?
Well, I think very good set of numbers from KEI, and they were able to grow the export market as well. So that opens up new avenues for revenues for the company. And also, I think on the retail side, they make great strides. They have, of course, completely wound down their EPC division, which is great because that was a high-risk business. And the brand remains extremely strong. Everything is good about the company except the PE multiple, which is at 50 times or so. So I would say that it's a hold for us. We remain invested, but from a fresh investment perspective, I'm not so sure. There are many macro fundamental reasons why the industry and the company should do well over the next 3 to 5 years or so. But it's just the valuations are on the expensive side for a business where there are many choices, and it's not like a concept business or something.
What is it that you like at these levels?
So I think, we are going more and more for some of the platform companies. So recently we looked at Zaggle Prepaid. That's looking quite interesting. Unfortunately, we were very positive on BLS International also, but then that negative news flow came over there. And then we like these online travel agencies like Yatra Online, looks quite interesting, very good set of numbers. Within the software, I'm getting incrementally positive, at least on Tata Elxsi. It's been an old investment of ours. Although results are not that great, but management commentary is positive, and new development center should start yielding good results, returns also.
Right.
So like that, I think there are a few companies which are in kind of different type of businesses that we're looking at.
Take that point. Thank you, Dipan, for joining in. We'll take a short break on that note. Come back on the other side. Dinesh Khara, the former chairman of SBI, joins in for a discussion on Emirates NDB looking to buy 60% stake in RBL Bank and its broader implications for the bank and India's banking sector.
Welcome back. You're tuned in to Bazaar Morning Call. Well, Ritu has been on top of the story with regard to RBL Bank, and now there's a fundraising as well that's due. So let's toss it across to Ritu, and she has Mr. Khara, who's joining in for a quick chat on what it could spell for the bank as well as the industry. Ritu, take it away.
Well, thank you so much, Nigel, for that. And, good morning and welcome, Mr. Khara. Thanks for being with us here. This highly anticipated landmark deal between Emirates NBD and RBL Bank, we understand for a 60% stake is set to be announced very soon. First, sir, on the structure itself, given the two sacrosanct numbers, 26% cap on voting rights and 74% on FDI. How do you expect this deal to be structured? What kind of regulatory hurdles do you think it may encounter?
See, as far as the 26% voting right is concerned, it actually comes from the Banking Regulation Act. So I think when it comes to FDI, the intention is very clear that considering the country's growth ambition, the banking industry has a major role to play. And to really attract the capital, the FDI has been actually structured in a manner that we can invite more and more FDI. So that's how it is. And 26% voting rights as it is gives adequate control for the bank, for the foreign investor also, to really ensure that it actually pivots the way they would like it to really perform. So I think, to my mind, it actually balances the various conflicting considerations which can perhaps be seen from the outside world. But in reality, it can actually work very well. to address both the concerns of the industry as well as of the economy and also of the foreign investors when they're looking for the larger markets in India.
Mr. Khara, we understand Emirates NBD is going to structure this deal through its wholly owned subsidiary in India. Does that make it a whole lot easier? Regulations are not very clear. If in the case of DBS and Lakshmi Vilas Bank, for instance, it was a 100% acquisition. Of course, there may be a glide path to bring it down to 74. Could we see something like that also? Or, what do current regulations tell you?
Well, actually, as far as RBI is concerned, they encourage, if at all, there could be locally incorporated subsidiary by these foreign banks, and that is something which was done by DBS. So, if at all, I'm not really in the know about Emirates, how they are going to structure the deal, but nevertheless, if at all they have some such design in their mind, it might also work very well. And eventually, that entity can also, at some later date, can merge into the bank as well, or in fact, that can work well.
Well, Mr. Khara, also just, to step back and look at a broader picture of, a foreign bank. We've seen Yes Bank SMBC happen, where, of course, State Bank of India was also involved. And now Emirates NBD with RBL Bank. What does this tell you about the, changing regime itself? Are we seeing a new RBI? Are we likely to see, more foreign banks coming into India, especially in the mid-tier private sector banks?
Well, to my mind, this can become a reality because many of the foreign banks are looking at the potential which is available in the Indian market, and it actually works very well. And since Indian banks also would need the capital in the days to come to support the growth ambitions of the economy, I would say that this can actually work very well.
To your mind, Mr. Khara, what are some of the mid-tier private banks where we may see some action, if I were to just put you on a spot?
Well, I think it would be difficult because when these foreign investors evaluate various entities, they look at multiple considerations. One, of course, the size, the business plan, etc., etc. So I think there are various considerations which will be subject to evaluation by these banks. It would be difficult to say that which all banks they might look at.
All right, Mr. Khara, thank you so much for joining in with these insights, and thank you, Ritu, for taking us through with that conversation. We wish you season's greetings as well, and we'll hope to connect with you if and when the deal is announced. As of now, 18th October is when, the board meet is scheduled for the fundraise. Let's see whether that gets announced on that day or not. With that, remember, do note CNBC-TV18 reported on Wednesday that Middle East lender Emirates NBD is looking to acquire up to 60% stake in the bank. With that, we'll take a short break, come back on the other side, technical trades with Mitesh Thakkar and Sudarshan Sukhani.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, the markets have been moving quite well. So let's get in a quick technical check. We have Sudarshan Sukhani of Technical Trends and Mitesh Thakkar of Bonanza Portfolio who join us. Good morning, gentlemen. Well, Mitesh, coming across to you first. Your take on the Nifty. We're approaching that 25,450, the level that we hit in September. And from there, we saw a bit of a U-turn. Do you think it has enough to get past that mark?
Good morning. The setup has turned positive in terms of the direction of averages and indicators, and I've been highlighting that much, saying that the first level on the upside should be about 25,350, 400 zone, which is where a declining trend line comes in. Yesterday, we managed to hit 25,350. I think a move beyond 25,400 will confirm some kind of a fresh breakout, and we should see then momentum increase. So in that sense, I think the belief and the overall idea is that yes, it's a very positive setup, and once this breakout happens, 630, 650 is my target area. But till the closing happens, you can have 1 or 2 days of subdued activity and a mild pullback. But the structure for me is positive, and I've maintained that 25,100 is the trend deciding level. In case unless until we close below that, I think we should take this market as a positively biased market.
All right, positively biased market. Sudarshan, your call on the frontline indices?
Yeah, good morning. Well, I've been consistently saying buy, be a buyer, keep a stop loss. That stop loss was 25,100. Luckily, that has not been touched on a closing basis, which is what I had said. So the trade remains the same. And I think this market is inching its way upward. And it's telling us that it's not willing to stop us out. And that's good news. Buy the Nifty, hold on to your existing long positions, buy on minor dips, buy on small consolidations. That's what you will get. And raise your stops to 25,200, but be on the long side.
All right, be on the long side. Do you have any specific stocks that you would like to trade on the long side?
Yeah, yes. There's a list always. TI India is a buy with a stop under 3,100. Asian Paints is a buying opportunity with a stop under 25.30. Trent is a buy after a long time. It comes in my list with a stop under 46.50. And finally, Dabur, which is a buying opportunity with a stop under 485. But I'll repeat, you must be long in the Nifty.
All right, must be long in the Nifty. A couple of consumption names. Yesterday, the consumer stocks did well. So you have Asian Paints, Trent, as well as Dabur and PI Industries. That's the one that we're looking at as picks from Sudarshan. Mitesh, your picks?
I have all long calls as well. On the stock side, we are still trading with very clearly a long bias. So the first stock is DLF, and the real estate pack is doing slightly good in the last few days. There's some strong buy signals on the intraday chart. So DLF is a buy with a stop at 744. Look for targets of 780. IRCTC is one stock which is now possibly suggesting some kind of a possible upside reversal. So wait for it to get past 719, 720, keep a stop at 709 then, buy for targets of 740 here. Also a buy on HFCL, if it crosses 78, take a stop just below 76, look for targets of 82. And Adani Ports is a buy, keep a stop at 1442 and a target of around, 1432 and a target of around 1485 can be looked at.
All right, just hang in there. Sudarshan, because you like the consumption stocks, I'd like your thoughts on something like a Nestle and Eternal. Both of them report their numbers. Going into numbers yesterday, they were fairly well bid. Nestle actually ended about 4% higher. Eternal too was up around 2%. Is there a trade there?
There are trades in both of them. Nestle is an investment idea, so you don't actually do a short-term trade in it. Right. That would not work out. But if you want to buy and hold for a few months, it's worth looking at. And Eternal is the exact opposite. It's a trading opportunity. Buy, keep a stop loss, and see where you can go, but also plan to exit it.
Okay. All right. Well, gentlemen, coming back to you all in just a bit. For the time being, I think we have Parag Thakkar who joins us, Senior Fund Manager at Fort Capital on the show. Hi, Parag. Good morning. Good to see you in. You track a couple of banking names that we're going to be in focus today. RBL Bank at around 300 rupees. Earlier, they were sitting on the fence, not confirming or denying that there is a transaction in the works. Now they're saying there is a fundraising in the works. At 300 rupees, what's your view?
So basically, say trailing book value is 257. We already have it in our portfolio and we plan to keep it because we feel that the tremendous attraction from global investors for our financial companies, which is very normal to expect because we are a highest growth country and financials offer a leverage proxy to the growth of the country. So I would say that it's a great development, huge money coming into the bank that will capitalize the bank for many, many years. And then, of course, it will start a new trajectory altogether. So
does that mean that other banks also benefit? If yes, then which would be on your radar because of this? Because now that RBL Bank has done it, obviously the gates open for others too.
No, so basically, I'm not sure. See, first we saw this happening in Yes Bank.
Yes.
We saw happening this in Samman Capital. Now it is RBL Bank. So the appetite of foreign investors or strategic investors to invest in Indian financials is there. Now, whoever wants to sell can sell, in my view. If it is a well-run bank with a good deposit franchise and good underwriting practices, it can be sold. And it can be sold at a good, decent price also and premium to the market price. Because we all know that RBL Bank a few months ago was trading at 200 rupees, right? And now we are close to 300.
Do you think IDBI Bank could be a beneficiary of something like this? I mean, what happens? There is a deal in the works there as well.
It is a large bank, so I would not say that it can happen at a significant premium. But of course, I think it is up for grabs because now PSU banks are also showing fantastic asset quality. So I would say that any bank, as I said, which has a good deposit franchise and a strong underwriting practices is up for grabs.
Earlier in the show, we had Dipan who said that PSU banks are, outperforming when it comes to fundamentals, and now the large banks, which were earlier, given a premium, the likes of ICICI, HDFC Bank, Axis Bank, all of them, their performance has become more PSU-like in the kind of growth that they are reporting. I mean, what do you make of Axis Bank's numbers?
I would say that PSU banks' performance have definitely improved. Their asset quality has become very good. But I would not agree with the statement that private sector banks have worsened. In fact, I would like to give an opposite view over here. I would say that private sector banks are thumping the table buys today. Even if Axis Bank falls because of this 1,230 crore one-off standard asset provision, it is a priority sector lending related declassification thing. It is not an asset quality divergence at all. So hopefully it will be a one-off. And just look at it, credit card and personal loan, both unsecured segments. The asset quality is stabilizing. So now Axis Bank can grow that also. All banks for that matter, Axis, ICICI, SBI, HDFC, all. And so the margins will have that kind of cushion. Thanks to RBI, there's a lot of liquidity in the banking system, which will give them cushion to grow advances ahead of deposits, which we have seen in this quarter, which will give them operating leverage, which will give them cushion to margins. So Axis Bank, for example, full credit to them that their NIM compression was only 7 bips QOQ to 3.73%. Plus the loan book growth was around 12%, deposit growth was around 11%. So operationally a very good quarter. It was just about this 1,230 crore which came as a shocker, but it is okay. It is one-off. I think one should avoid it. One should see it through that it is a 1.7% ROA bank growing at 14-15%, available at 1.5 times book and 10 PE. And so that makes an attractive investment case for Axis Bank. And I would say, in fact, that this Axis Bank result will extrapolate into rallying private sector banks like ICICI Bank, also in PSU banks like SBI, as the growth rate expected by the market is being beaten. And the margin compression also, these banks are actually outperforming versus the expectations which were very low. So, for example, Axis Bank NIM compression was expected to be above 15 bips. It has come to 7 bips only. The loan book growth expectation was 3%. It has come to 5% QOQ and YOY 12%. So I would say that, in fact, the case is building up for re-rating of banks.
And in pre-open, the market is clearly latching on to what you had to say. You're saying the read-through actually is positive, and Axis Bank, at least the initial rates that we're getting in, it's not a red. In fact, it's a mild positive tick. So the street is willing to look past that one-off and looking at the positives as well. So let's see where it settles at, but for the time being, a bit of a positive take. Parag, you're sounding optimistic on banks. In the past, we spoke about ICICI Bank, HDFC Bank, RBL Bank, and now SBI as well. So give us the top three in preference-wise, because RBL Bank, I think you're in very, very early. So do you think most of the good news is in the price now? What target price would you look at? And give us the preference. Go ahead.
So preference-wise, see, my portfolio reflects it. It is ICICI, HDFC, SBI. This is the preference. Of course, Axis Bank, if there is, in fact, I was expecting that some people might get frustrated and will sell, and that will be an opportunity to add, but let's see what happens. But I would say that City Union Bank is one another bank which we have in the portfolio, and RBL, of course. So I would say that this is the preference, and RBL has rallied going into the event. So I would wait for a while, let it consolidate, let the new management, the new investor come in. Let's see what they do. Let's see what their plans are, and then have a relook and then buy.
All right. What about other sectors? Is there anything particular that you like in other sectors?
So basically, my view is that, see, today Infosys and Wipro are going to report numbers. Let's see their numbers and let's see their commentary. IT is one sector from long-term perspective. It's a good contra buy in my view. And at the same time, FMCG is also a good contra buy in my view. The prices have corrected significantly. And of course, the interest rates, one thing is given now that rates are going to get cut, right? The rate sensitives like NBFCs and real estate, we did well yesterday. In fact, we have DLF and Oberoi Realty in our portfolio, good weights. And NBFCs, we have Piramal, we have Geofinance in our portfolio. So I would expect that all these things to do well. So I think overall the market looks very good in my view, because I think the Fed has also said that they are going to stop quantitative tightening, which augurs well for emerging markets equity also.
Interesting. So in that case, I think you'll definitely keep your eye out on all the results that come in today. Two big ones from the FMCG consumption pack and two from the IT pack, like you spoke about as well. Let's get in, one more question coming in from Mitesh, I presume. Mitesh, yesterday in the last hour of trade, we saw an uptick in Trent. Do you believe that that uptick was tradable?
To me, I think, Trent has been into a strong underperforming zone, but now it's getting very oversold. So yesterday was the first sign of a bounce back. The recent swing pivot was around this 48.50 to about 48.85 zone. So I think that could be a bounce back day. But if we see the stock get past 48.85, 4900 levels, then I think we'll look at a proper reversal.
And what do you think of Quick Heal? Results were great, but ahead of results itself, the stock had seen a big rally. In fact, this week, ahead of the numbers, the stock was up around 12-13%. Yesterday as well ended higher with a fair amount of volumes backing it. Do you think this price volume sort of up move would take Quick Heal higher from here on?
Quick Heal is something not tracking regularly, but my initial understanding of looking at the charts is that there was this strong base building around this 280 to about 300 zone, and therefore a good up move would start. The first target is 370, followed by about 395 to 400 as the range. So I think the stock is heading towards those levels.
All right, good time to get in the 9-10 call then. What would your 9-10 call be, Mitesh?
I would go with the buy on Adani Ports for targets of around 14. Adani Ports is a buy, and I would look at a target of around 1485.
Okay, all right, let's get in Sudarshan. Sudarshan, what about your call?
Well, it's Trent. Consider buying Trent with a stop under 46.50.
Okay, all right, gentlemen. We'll come back to you all and revisit some of these calls. But let's go to the other Sudarshan, our teammate. He's here. He goes through a lot of brokerage notes, been reading up. But today, I think he's bringing us two special ones. Tell us, Sud.
So I have traded two stocks and both are from the auto pack, and first one is Tata Motors Passenger Vehicles after the demerger that's known as Tata Motors Passenger Vehicles, which houses JLR, Indian Passenger Vehicle, and the company's stake in Tata Technologies. So BofA Securities has come out with a note downgrading the stock to underperform, and target price it has given is of rupees 375. And the downgrade is mainly because of the situation that JLR is into. And JLR forms almost 45% of the target price that BofA Securities has. And it says that cyber issue, US tariff, and the slowdown that company is facing both in US and China, it might weigh on the stock of Tata Motors PV, and also balance sheet overall may again face the issue of increasing debt build-up going forward. While for India Passenger Vehicles, it's saying that in the last 1 or 2 months, it's back towards gaining market share, but the problem remains the margin front. Company has to make sure that margin improves for India Passenger Vehicles business as well. Second note is on Hyundai. Again, it's from BofA Securities only. It has upgraded the stock after the investor day meet, and the target price it has given is of 2,800 per share. It says that new launches going forward are going to increase further, and it sees further upside to the volume guidance. And also market share, it's expecting to rise significantly from FY27, while margin is going to remain steady. Remember, Hyundai has given the margin guidance in the range of 11 to 14% from FY26 to FY30. Also on the valuations front, it finds risk reward favorable.
Well, you spoke about Hyundai. Yesterday itself, our colleague Parikshit spoke with the management, and here's a slice of that conversation on the management's way forward in terms of growth for India.
The main message that I've conveyed to all the stakeholders, including, of course, the shareholders in attendance, is that India is not important for the strategy of Hyundai, but it is the strategy of Hyundai itself. We're going to deliver in this market more than 800 and 60,000 total sales in the market. And then we have announced also an increase in capacity to 1.1 million, which would allow us to be, already we are, but to be by far the largest exporter of vehicles from India.
That is Hyundai speaking to Parikshit post the Investor Day call and betting big, doubling down, tripling down, as he said, on India over the next few years. In the pre-open, it's a positive start, close to about 0.3%. The Gift Nifty is up close to about 70-odd points. So it suggests that the recovery that we saw yesterday will extend itself. So trading with a positive bias right now. The stocks which you should have on your radar this morning, as we pointed out, on the earnings reaction front, HDFC Life, HDB Financial, L&T Financial, KEI Industry, MRPL, Rosari Biotech. These are stocks you should keep. Angel One, Oberoi Realty, Axis Bank. And Axis Bank, at least in pre-open, is the big star. That's up close to about 4%, and it's pushing up a couple of the other banking names. So I can see HDFC Bank, Innocent Bank also trading with a positive bias in pre-open. And RBL Bank, it's been the stock in the spotlight for the last couple of days now. And now 18th of October is the board meet where they will consider a fundraise. The stock has doubled since the start of the year. But Mangalam, these are the earnings reaction. To watch today, there is a lot on the consumption plate.
Yep, you are looking at Nestle. The stock was doing well in yesterday's session, but importantly, it's 10% away from its 52-week high, trading at 60 times, 62 times, so to say, but not much expected from this quarter's performance. All eyes on the next quarter's performance. So revenue up 3.5%, 5,300 crore thereabouts is what the street is working with this time around. EBITDA largely flat, which implies a margin decline of almost 100 basis points, 22% versus 22.9%. And the net profit on an optical basis declines by 28% because remember, there was a one-off gain in the base quarter. What is more important to look at this time around is the absolute performance. Out there, you're looking at anywhere between 700 to 710 crores on the bottom line. The impact of GST-led trade transition would be anywhere between 350 to 400 basis points. So had it not been for the GST rate cut, you could have seen a revenue growth anywhere between 7 to 7.5%. 3 to 4% growth in their domestic business, 7 to 10% growth seen in exports, domestic volume seen between 1 to 2%, and 80 to 100 basis points impact on account of higher prices for some of their key raw materials, which include the likes of milk, coffee, and cocoa. More importantly, trajectory on growth in their pet care business, demand post GST, and strategy from the new leader, Manish, who takes over from Suresh Narayanan. The other one, which we're looking at, is Eternal. More importantly, here too, the commentary on competition for both food delivery as well as quick commerce will be extremely crucial. But year on year, these numbers are likely to be very strong. Revenue growth of almost 66%. EBITDA grows much lower than the revenue at 13%, which implies margin compression. But that's largely expected because of the strong expansion that the company has been doing on their quick commerce front, and as a result of which, there'll be a decline of 21% in the net profit. Nothing really to worry about here because a large part of that decline would be on account of higher depreciation. What the company has to say on food delivery GOV and the outlook for margins or reduction of losses in quick commerce would be the ones that would drive the stock from here.
Okay, and not to forget, lots on the technology plate too. So Infosys and Wipro, actually both of them. So we'll get a complete picture of the large cap IT action. And so far, TCS, HCL Tech, Tech Mahindra have all reported beats on muted expectations. In the case of Infosys, we'll have to watch if the FY26 guidance gets tweaked. And in the case of Wipro, the Q3 guidance will be very critical. And we've got two mid-cap IT companies, LTI Mindtree, which moved up 2.5% following the rub-off from Persistent, and Cyient. So mid-cap IT consumption should be on your plate. The bell has gone and the Nifty has opened at 25,400, a gain of 78 points, continuing with the up move from yesterday. Yesterday, we closed with a gain of about 180 points, and the Nifty this morning has added another 75 points. Sensex is up close to about 250 points. It's banks leading the way. The Nifty Banking Index is up more than 300 points, a rally of close to about 300 points. And it's Axis Bank all the way. Axis Bank is your top Nifty gainer, 3% up. The street is shrugging off that one-off provision impact on the bottom line. Most analysts are happy with the operational performance, the asset quality, loan book, and the stock is the big mover. And it's lifted up a Kotak Mahindra Bank and an HDFC Bank too. So Kotak Mahindra Bank is following close with a gain of about 1%. Eternal, another fresh record high on Eternal. The street awaits the numbers. The estimates are for a 65-66% jump in the company's top line in Q2, and Eternal is gaining ground. Two-wheelers also seeing some buying action today. So it's a firm opening for Hero MotoCorp, for Bajaj Auto and Eicher Motors. Now, ICICI Bank too is moving up. So ICICI Bank has a gain of close to about 0.5%. On the consumption plate, you've got a little bit of green coming in on Trent. On the way down, you're seeing softness coming through on the life insurance companies. So HDFC Life, SBI, sharp fall coming in on HDFC Life. Pull that up. It's 4.5% gone on that. So HDFC Life looks like the casualty. And Infosys, ahead of the numbers, is seeing some softness. In fact, so is IT. So TCS, Wipro, Tech Mahindra, 2 in the red.
Two stocks. One is KEI Industries.
Yes,
the results were good. The 23% growth that we've seen in cables and wires business. But there's something that the street does not like. Maybe it is, something led to the GST-related transition or the impending competition or how the volumes and margins of this business would be going forward. So something that the street does not like about these numbers, down about 7% counterintuitively out there. It's not that, the stock had seen a big move ahead of numbers or something of that sort. That's lower by about 7%. The other one is Oberoi Realty, up around 5% despite a decline in residential sales versus their peers. So, the street perhaps looking ahead. And the third one is RBL Bank. That one's opened fairly in the green after the management has said that they're going ahead with a board meet on fundraising. And the stock, remember, is out of F&O ban as well. So these three stocks on the broader markets definitely stand out. By and large, more stocks in the green than the numbers in the red, Nigel.
Well, KEI Industries, will have the management shortly with us, as well as HDFC Life. So we'll try to pull out some numbers from them. Both of them, the two earnings casualties of the morning. You have a few stocks that are doing well. Keynes Technology, that stock is higher by close to 2%. They have shipped 900 multi-chip modules to the United States. So that's why, in fact, that's a little bit excited in trade. The earnings reactions this morning, there are a few actually. Huhtamaki Paper, that stock, in fact, is higher. The margins have moved from, I think, low single digit to closer to around double digits, high single digits. So the street likes that. Huhtamaki is up and about in today's trading session, one of the top winners out there. MRPL, we had mentioned it could potentially be one of the stocks of the day. Not just the operational performance has improved, they have gone ahead and they have pulled back on the debt as well. So that's why the stock is doing well. And at the end of the first quarter, actually, the stock got slammed, because there was an inventory loss. This time around, that wasn't the case. So that's why that stock's doing well. And what's giving it company on the upside is Chennai Petro. Remember, the street was bracing for a better second quarter, and we had mentioned this as well. First half of the year could look good. So that's why the read-through out there, and that's why that stock is up 4.5%. What else? Quick Heal. Stock is firing away in today's trading session. Well, that's doing extremely well as we speak. Big up move is what we're seeing on that one. 7.5% higher. What else? I think on the losing side, the HDFC Twins, that's Life, and AMC is lower. KEI Industries is down, but I'll tell you what, Polycap as well is down. That's down close to around 2.5%. So it's having a bit of a ripple impact on some of these other names. We'll wait to hear out from the management as well. But let's welcome then our market master, our market guest. We have Gautam Charcharia, Head of Global Markets at UBS, who joins us on the show. Hi, Gautam. Where are you joining us from? India or?
Still on Diwali break already. So, but again, you guys wanted me to be there. So, yeah.
Good.
Happy Diwali to you and all the viewers.
Happy Diwali to you, to your entire family as well. I briefly bumped into you a couple of weeks or so ago. So you're clearly in festive mode, Gautam. But what do you feel about the markets? Everyone's talking about this last 1 year underperformance, that the Indian markets didn't party. You think our time has come?
I think three points. Technically, the markets are still stuck in range bound. And I say that simply because there is enough local liquidity in terms of mutual fund flows to support the market on the way down. But there's also a large pipeline of capital raising, which will potentially cap any meaningful upside. So that's a technical part. But beyond that, tactically, again, if we see progress towards a trade deal, that will provide some legs. Fundamentally, the valuations in absolute terms, earnings outlook, if you combine that, that's still not appealing risk reward for the broader market yet, unless we see a big breakout in fundamentals. Again, there's been a lot of hopes around consumption and GST cuts. But we have to see beyond that, because the consumption stimulus or GST cuts can provide near-term support to economy, but it needs to be followed up through a broader capex cycle if we need a sustained economic cycle. So that part is still missing or still something to see.
On the EPS front, Gautam, what is your expectation for the remainder of this year and more importantly the next year? Because most on the street are pricing in 15-16% plus EPS growth in FY27. Do you think that's possible?
So look, I think the estimates for the street is not what investors tell us. In investors' mind, I don't think they're looking at 15-16% growth for Nifty EPS in FY27. They are more like high single digits to low double digits. That's where the market expectations are. And that's something definitely should be feasible. In fact, 15-16% is now not out of range simply because of the low base which will be there. And there'll be some impact from GST cuts, policy easing, etc. for sure.
And this particular year, I mean, do you think the second quarter is practically a washout quarter, so to say? The next couple of quarters where a lot of hopes are pinned because of the GST cut, and you're saying that there is a short-term impetus likely. So do you think a bump up in the third and the fourth quarter?
Again, some marginal bump up, yes. Meaningful bump up, too early to say. Like we have seen even the GST, the big debate out in terms of what the impact is. And our auto analyst had a very interesting note out that while if you look at just the Navratra period, the headline Y&Y growth for two-wheelers, four-wheelers is 20% plus. But if you start from, say, the Onam period, which is the right way to look at from adjusting for seasonality, etc., the growth is lower single digits. So we're still not seeing the big impact yet, which gives us confidence that we'll have a sustained upcycle. So it's early days, but again, a marginal uptick in 3Q, 4Q for sure. Whether it's going to be meaningful or not, it's too early and fingers crossed.
So auto sales, you're saying it's a subdued uptick, just about 9% if you look at the cumulative festive season sales. Are you getting a similar data point from the other consumption indicators?
Again, it's a mixed bag. Look, the FMCG, the consumer staples, etc. There, the inventory part has been much more, or is making the scene much more noisy around the GST cut. So very early days, and again, looks like the uptick is not as strong as initially believed. But again, the four-wheelers, two-wheelers, we saw some uptick in the festive days specifically, but for an entire season, it still looks below expectations.
Got that. So we are overestimating the benefit on consumption on account of the GST sales. Is that yet to reflect in the stock prices? Would you say that?
So I won't say overestimating as yet. In the last couple of weeks, the markets got ahead because the GST cuts are permanent. So the impact is not just for the 15 days. It will remain as we go along. So that's a great thing in terms of the cycle. In terms of stock prices and markets, again, markets, as I said, is stuck in a range-bound level. Hasn't moved up, hasn't moved down materially. So it's not really pricing in any major uptick from GST impact. No, it's not pricing in yet.
So since, Gautam, Indian markets have been range-bound and you're the head of global markets, if you just zoom out, India's range-bound performance has underperformed, say, Taiwanese markets or Korean markets where you have a lot more AI plays and they've been the big beneficiary of this tech upcycle. Is there anything on the horizon which warrants a change that perhaps investors will start looking at India, maybe because the other emerging markets have run up too much, the valuation, the gap between the two has changed, or the fact that India's earnings, maybe on account of a low base, is changing? I mean, is there anything which makes you believe that India's underperformance vis-a-vis emerging markets could reverse?
Look, our EM strategist still remains underweight on India from an EM portfolio context. Having said that, tactically, yes, we have seen a big divergence, or as you said, India underperformance this year. And if you see some progress on trade deal and some impact of GST, etc., locally, then yes, underperformance can reverse fairly quickly. Because positioning-wise, from a global investor positioning, it is light from an India perspective. Both positioning in terms of actual weightage in their portfolios, as also their sentiment and outlook. From our discussion with global investors, it still looks like they're not in a hurry to take up an India weight to any meaningful overweight in a hurry. So that positioning gives us comfort that if things fall in place, this underperformance can reverse fairly quickly. But is it going to happen in the next 15 days, 1 month, 3 months? That's the tough part to say. Over the next 6 to 12 months, possibly.
What do you think has to happen for this to turn? Apart from, earnings, obviously you will see some green shoots out there. It doesn't happen immediately, like you said. But there could be something else that may happen in the globe that may not, make the investors of that country or money which is going to those countries be favorable and perhaps be a tactical shift towards India? What could the scenarios play out as?
There's kind of maybe a kind of a circuit breaker around what's been happening around North Asia, China, between US and China, as you've been reading the news. Again, what our reading is, talking to investors, markets, I think everyone expects this to be short-lived. And we have seen markets being largely resilient around that. So I won't go on a defensive approach saying that, okay, things are not good between US, China, and therefore India will benefit. I would look at more if there's a real good India-US trade deal, which gets India's tariffs back to a competitive or even very competitive level versus its trading competitors. That will be a big catalyst for Indian markets, for sure.
So how are you positioning yourself, Gautam? I recall, there was a bit of a move between industrials as well as consumption. At current reckoning, the GST 2.0 is here. We know what the spends are. I think private spend still needs to pick up. Private capex could be the big trigger, I think, the big monitorable for the next 12 to around 18 months. How would you position, between capital goods, industrials, and consumption on the other hand?
Thematically, we still overweight consumption, but again, it has to be pick and choose rather than a broad consumption pick. Like one of the themes we are clearly picking up in consumption across the board, which includes staples, discretionary, etc., is premiumization. Like autos, our analyst thinks the street is possibly overestimating in terms of the near-term growth. But within that, the premiumization plays will possibly even surprise positively. So premiumization is one big theme. The second big theme around consumption is the consumption tech or internet or food delivery and quick commerce. There we still expect market's estimates to be met or even beaten. So that's another space where we are very, very positive. Industrials, we still remain broadly positive on defense, but again, selectively. So the stock level is much more selective. But again, at the macro level, it's more consumption over industrials. The other two I'll mention where expectations are fairly low and positioning light is IT services. Again, there's a debate about the longer term, but near term, the positioning, especially amongst global investors, is one of the lightest we have seen. And as we've seen in the early results for IT, the expectations are so low that companies are actually meeting or even beating, especially the mid-cap ones. So the mid-cap IT space and similarly financials, there are pockets which can deliver given the muted expectations, not in absolute terms, but given the muted expectations.
So in the large cap consumer names, what would be the ones that would, stand the test of this premiumization best and perhaps be investable right now?
So again, the autos, there are two-wheeler and four-wheeler names which are the obvious beneficiaries, both premiumization as well as the EV. So that they are our top picks in autos and broader consumption space, or consumer-linked space. Within consumers, we would prefer the quick commerce delivery guys, and then specific companies which are playing up. Again, I can't name individual stocks, but specific companies geared to the premiumization theme, which is well known, the larger consumer FMCG companies.
So which would be, something in the beauty and personal care space, a marketplace out there as well. Then there is, a recent entrant, which is in home services, which is pretty similar. The TAM, they say, is pretty similar to that of all the quick commerce players. Would you look at any of them?
Look, broader marketplace / the internet consumer tech space, we remain positive. The home improvement, the new entrant which you're talking about, we don't have coverage on that, so I can't comment on that. But the broader home improvement space, we remain constructive.
Okay. Can you buy it at this juncture, these consumer tech platforms? They're great stories, but it's great if you've already entered in and you got in at a lower price. But at this price, how comfortable are you?
We're very comfortable. And again,
even to buy at this juncture?
Absolutely, because our analysts have done deep dive work on the TAM. And that one observation I have is that I have seen the TAM, even by the bullish analyst, expand over the last 1 year. The TAM estimates.
Gautam, thank you very much for joining us from your holiday. Wish you, your family, the entire team at UBS season's greetings and look forward to chatting with you next time. Do come down to our studio.
Will do. Thank you.
Thank you.
All. Thanks.
Happy Diwali once again. Let's get to our corporate corner then on the show. IRFC is the company on our radar. Manoj Kumar Dubey, the chairman, managing director of the company, is now with us. They came out with their Q2 numbers. And what we would like to chat with the management one is, will the strong sanctions continue? They had guided for double-digit profit growth. Is that here to stay? And the opportunities under IRFC 2.0. This IRFC 2.0 is that historically this company functioned as a dedicated financing arm for the Indian Railways. Railways. So the entire order book would come in from leasing projects assets related to Indian Railways. But about a year back, the company embarked on a diversification strategy, which is called the IRFC 2.0, where they're seeking to fund even the broader railway ecosystem. So whether it's CPSC, state government entities, metro rail project, even renewable power projects, which are linked to railways. So that's the IRFC 2.0. Thank you very much, Mr. Dubey, for joining in. We'll come to that. But briefly, just first about FY26. You had given a guidance of 30,000 crore of disbursements for the full year. In the first half, I think you've done about 21,000 and 60,000 crore of sanctions. Again, your run rate is at 45,000 in the first half. What will these two numbers look like for the full year?
So, good morning, Rima, and I think you have made my job easier with giving the main part of commentary that I was supposed to give. So thank you for all the homework that you did for IRFC. So yes, as you rightly mentioned, in the March of this calendar year, we embarked on our IRFC 2.0 journey. And we started from one client model of Indian Railways to multi-client model within the government system, who are having linkages with the railways. And I'm very happy as you put up the numbers. We gave a guidance of sanctioning 60,000 crore of assets. We have already crossed the mark of 45,000 crore in this one half of the FY. That shows the way ahead. I mean, I don't want to put in numbers over and above that, but if you can put numbers, this 45,000 in one half of the calendar year, of the financial year, we are going to go extra miles going ahead. So far as our strategy is concerned, we are actually focused on growing our PAT in double digit. That is a vindication for the fact that in Q1 and Q2 both we showed the same kind of thing. There is one more clarification regarding our revenue. The dip in the revenue is not because of any other regions, but for the fact that there is some accounting system. A moratorium that we had given to Indian Railways for projects for 5 years, we have extended by a year. So it is just the accounting thing. Next year, when we sign the agreement for this year as well as next year, the upside in revenue also will be showing the same thing going forward.
Okay. Sir, on sanctions, you did 45,000 in the first half. Is there any reason to believe the second half will not be as strong as first half? And why are you not in a position to raise the full year guidance from the current 60,000?
I mean, as the head of the team, if I'm giving very stiff target to my boys and girls, it is little too much on them. Okay. But believe me, the way they have performed in the first half and the kind of queries we are getting from all over in the railway ecosystem, obviously, we won't say no to anybody who is coming to us with a good quality of assets.
Sure.
So obviously, the target is going to be achieved. It is going to be more than what we have given the guidance, and that is what we are happy for.
Okay, so you will beat the guidance on sanctions of 60,000 crore and 30,000 on disbursements for FY26.
It looks like obvious for the. Yeah. It looks like obvious for so far as sanctions of the assets are concerned. So far as disbursements are concerned, as you know, there was zero pipeline when we started on 2.0. And disbursement comes out of sanction of the assets only. So this year, 30,000 is a very good target that were given to us. And we are pretty sure that with the kind of progress we have and the kind of offerings we have in the kitty, we'll be crossing that, if not achieving the same.
Okay. Right. All right. Hi, Mr. Dubey, and good to see you, Ben. You know, in the past, you were telling us how the business model is evolving, right? From just being core railway, you're moving to non-core railway, and that's what will help in terms of margin improvement. So tell us, what is the targeted NIMs you're looking at? And this disbursement target, you're sure, right? 30,000 is on. Because your boys and girls also, either they'll be keeping an eye out on this interview as well.
So actually, we talked to you in the beginning of this FY also, that our focus is on yield. So PAT will be derived with better NIM. And the sweet spot or the better time that IRFC is having going forward in diversification is the fact that our NIM is now growing for the new businesses in 2x and 3x times, despite being very competitive in the government ecosystem. So obviously, you see the kind of NIM that we are having right now from 1.4, it has grown to 1.55. And the new businesses, our NIMs are going to be between 2 to 2.5. So going forward, for many quarters that are going to come, we will be having better and better NIM, better and better PAT, and a very consistent PAT. So this is a company where there is very minimal risk of any kind of prepayments, because the government side, it is a very steady kind of business. And because our rates are very fine compared to the peers, we have zero risk of any prepayment coming from our customers. All taken together, A, our NIM is going to be improved every quarter. B, my PAT is going to show a very steady progress. The target that we have given is our yield should be in double digits. So obviously, we are targeting to grow our PAT 10% or more every quarter ahead. And the plan is set for next 5 years as of now.
Got it. We got the broader horizon, sir. Just on disbursements, you're talking about 30,000 crores. First half of the year, how much is it?
First half, we have already disbursed more than 7,000 crore.
7,000 crores.
Because, the pipeline was zero when we started. So now the pipeline is coming steadily. We are very sure that with a few refinancing projects also in hands, we will be crossing this barrier of 30,000 that were given to us majorly in Q3. And whatever will be left, we are very confident that we will be crossing that in Q4.
Right, we take that point. Now, on beyond railways itself, if you would give us a sense on how much does railways account for your overall order book, or rather, your loan book right now, and where do you see that number headed over the next 3 to 5 years?
So that's the beauty. For the last, this is the third consecutive year when we did not get any order for funding to Indian Railways right now. This trend may continue for a year or two, depending upon how budgetary allocations are done by Government of India. Every February when the budget comes, there are many ministries competing for the government budgetary support. Right now, it is coming in abundance to railways. In future, if there is any deficit in the need of the railways, we are there to pitch in as their principal financiers. In addition to that, what we are doing is, as per our mandate, we are funding to anything which is having a link backward or forward with the railways, like the port connectivity, like the power supply to the railways, like any other railway linkages where hauling is done by railways. So this 45,000 crore asset that we have signed is all in the linkages, not directly to the Indian Railways. And we believe that going forward, the kind of queries we are getting and the kind of assets that are being offered to us, steadily 60,000 to 80,000 every year we are going to mop up from outside railways. And whatever comes to the railways will be cherry on the cake, because this 60 to 80,000 crore that we are targeting to mop up from the railway ecosystem, here the margins will be better, NIM will be better. In the railways, we worked on cost plus model where 40 bips is fixed for us for any kind of lending that we're doing. So taking two together, IRFC is placed for a very exciting time going ahead. This is my take.
Very quickly, in your words, you said that, the goal is double-digit profit growth quarter after quarter for the next 5 years. The plan is set. What is the 5-year roadmap? I mean, what is the aspiration, the ambition? Can you quantify that? 5 years.
Please say it again.
When you were giving the earlier answer, when you were talking to us about moving to higher yields, double-digit profit growth, you said that's the aspiration quarter after quarter for the next 5 years. The plan is set.
Yes.
So what is the 5-year plan for IRFC? Is there, and can you put that in numbers? We understand the broader picture about, moving beyond the Indian Railways. Absolutely. They play the ecosystem.
So absolutely, there was a dip in our asset under management for the last 2 years because there was no business coming from the railways. This particular quarter, we have reversed the trend. Now, going forward for the next 5 years, the plan is that our asset under management will be growing smartly, steadily. Coming out from that, our PAT will be growing every quarter. This is what we have set forth. How this PAT will grow and how this AUM will grow is derived from the fact that we are very hopeful, and the kind of competitiveness that we have in terms of our very less overhead, that in the railway ecosystem, which is huge, having port to electricity to logistics to MMLPs everywhere, we feel that with our very competitive rates, we will be garnering 60,000 to 80,000 crore kind of assets every year. This is a target for outside railways having linkages with the railways. Going forward, we also looking forward to the fact that maybe the Indian Railways, with their appetite of more than 2.5 lakh crore of capex every year, there may be a demand from their side also for funding. Taking two together, with these numbers, we are very confident that with zero risk of prepayments, as we are having very competitive rates offering to our customers, our PAT and revenue both will be growing steadily.
We wish you well, Mr. Dubey, and thanks a lot for speaking to us here on CNBC TV18. Happy Diwali in advance to you as well as your entire team, and we look forward to tracking the progress of the company.
I just wanted to convey happy Diwali to the whole CNBC team, as well to my 55 lakhs plus base of shareholders. Thank you so much.
All right, 100%. We wish all of them, your team, your shareholders, and everyone a very, very happy Diwali.
And more than 55 lakh viewers of CNBC TV18 as well. Thank you so much.
All right, time to slip in a short break. We got another conversation on the other side. Vibha Padalkar of HDFC Life Insurance will be joining in to detail the past quarter's numbers. Welcome back. This is Corporate Trader, and you're tuned in to CNBC TV18. Well, let's focus on another number that did come out yesterday, HDFC Life. The management's next on the show. The stock is under some pressure after reporting its Q2 numbers. We're now joined by Ms. Vibha Padalkar, the Managing Director and CEO at HDFC Life. Hi, Mr. Padalkar. Good morning, and thanks a lot for joining in. Well, the street doesn't seem to be very, very impressed with those numbers. But importantly, what about the second half of the year? That's going to be important. So fill us in with a couple of numbers. One is the growth. What kind of growth projections are you looking at? APE growth, I think some on the street are expecting around 14-15%. So you could tell us what do you expect on that. And VNB margins as well. Last few quarters, because of a variety of factors, it's come down to around ballpark around 24%. Do you see it stabilizing around these levels?
Hi, good morning, Nigel and everyone else on the panel. Actually, I want to deconstruct this into two parts. We had a fairly good quarter and we had a fairly good H1. We also delivered in terms of no surprises from an operating perspective. This is despite some of the external turbulence caused more notably due to the GST changes, which is largely welcome, but there would be a impact over the next couple of quarters. In terms of deconstructing why I'm saying we had a fairly good quarter is that we did see market share expansion, both in Q2 as well as overall in H1. In fact, the market share expansion in Q2 was even better at 100 basis points than the expansion of 90 basis points in overall H1, so versus Q1. Right. Also, the overall growth and hence was faster than the sector. All the right notes were hit in terms of retail protection growing at 34% in Q2. And as a result, sum assured also growing in the mid-20s. Embedded value, operating profit, new business margin, excluding the GST impact of 0.5%. So actually, there was a margin improvement underlying. And also in terms of some of the other metrics, whether it is in terms of new customers. So new to HDFC Life customers continued to be 70+%. These are first-time buyers of HDFC Life products. Annuity continued to grow. And more importantly, our agency channel, which we have talked about investing in, that also grew fairly well. Renewal premiums were robust. So really, it's a story of two halves with and without GST. But underlying performance is more than meets expectations.
Okay, all right, Vibha, you've given us a fair idea. And, the reason why you believe these numbers are good, market share gains, and also given the challenges, you're seeming fairly satisfied. But let's talk about growth. You could break it down, APA growth, retail growth. What kind of estimates are you working with for the second half of the year and what that means for the full year on the whole? And also VNB margins, my earlier question. Will it stabilize around these levels?
Yeah, on growth, what we have said is that it was a story of two halves based on the growth last year for us and for some of the larger players in the sector. So for HDFC Life, H1 last year grew by 31%. And also to remind your viewers that we had a withdrawal of the old surrender charge regime. And so quarter two growth last year was very robust. Like I said, overall H1 growth of 31%. So there's a large base effect, which then normalizes in H2. And hence, what we had mentioned is that growth this year will be in the early teens. We also are fairly coupled with whatever is happening overall in the macro situation, whether it is the political global turbulence, as well as in terms of what's happening on job creation, savings rates, and so on. And hence the slightly more muted growth of about, like I said, early teens. So that's very much in the ballpark, maybe a month or so here and there, but fairly good. And we've also said that while we think it is going to be in the early teens, we will still grow faster if the market starts growing faster. And that's something that we have delivered on. In terms of outlook, no change in the outlook as of now. What we have said at the beginning of the year should continue, us continuing faster than the sector, and it will be in the teens.
Right. Just on the GST front, you did quantify that impact at about 0.5%, but that was just 8 days during the second quarter, right? On the third quarter, what could the impact be? And if you could, simplify that for us, how much would be the increased, sales on account of lower prices to the customer, and how much could there be an impact because of the lack of GST input credit?
Yeah. So the answer is in two parts here. One is on the back book, which we had quantified soon after the GST announcements were made, which we said it's unlikely to exceed more than 0.5% of our embedded value. And I'm happy to share that we are a shade lower than what we had put out, because we put it out immediately, but bottoms-up calculations at policy level also gave similar answers and a shade better. So that has been articulated and it's there in our investor presentation. On going forward business, there are three components. For this quarter, so quarter two, there has been, like you said, 1 month's impact. It's strictly from September 22nd, but people did defer purchases of life insurance policy. So effectively, it's like close to a month's impact. And on quarter two, if I were to just have share the impact on three key metrics, our PAT looked anemic at 3%. But if I were to remove the GST impact, it would be closer to 15%, both for the quarter and for the first half of the year. VNB growth at 8% would have been 11% for the quarter and about 12% for the first half of the year. And finally, on margins, our margins as against 24.1% would have been 25% for the quarter, and as against 24.5% in H1 would have been 25% in H1.
Right.
So
Thank you for articulating that. And just before we toss to our colleague Yash, just one question on the ULIP front. You wanted to bring it to sub 30%, but now it's still at 42%. What's your path to 30% here? And because it has an impact on your margins, right?
So a very good question, Nigel. And what we are trying to do is work within the system. And by that, I mean, unit-linked, like with equity mutual funds, continue to be, customers find it attractive. So rather than pushing back against it, we are trying to see how we can increase the profitability as well as suitability for more affluent customers. And so having higher levels of mortality cover, given that the avatar of unit linked is something that people understand, can we give more than 10 times cover, which is a very low level of cover? Can we increase it closer to 50, 60 times cover? And that's really what we're working on. And we've made meaningful impact and inroads into that. And hence, if you were to look at our sum assured just for the quarter has grown by 26%, which is more than double our company level growth. And that really shows that mortality cover, that part of our business is growing fairly fast. Part of it is due to retail protection, but also meaningful part is due to higher cover within unit linked. So getting more profitable.
Hello, Vibha. Good morning. This is Yash. To answering to Nigel's question, of course, you did mention that you expect early teens growth when it comes to AP and VNB. But margin seems to be an important point here. In the last 3 years, FY 23, 24, 25, the margins have receded every year by about 100 basis points. H1 FY26 to FY25, they are largely flat. Do you expect similar deceleration, that is of 100 basis points in margins, to happen in this year also? And at what point and by what time period do you expect stability as far as margins are concerned, or do you think a floor has been hit at current levels?
So I want to counter that slightly. I want to clarify that, Yash, because margins have not decelerated ex-GST. So if I were to look at H1 margins last year at 24.6% versus a pre-GST margin at 25%. Post-GST is very close to last year's margins. So there are these two one-time impacts that have dented the core operating margins of the entity, which has been steadily rising. One is, as you know, surrender charges, which had a 0.3% impact on margins. And if you look at last year versus the year before that, so when surrender regime came in versus before that, it's really only the impact of surrender charges. Everything else has been neutralized by us in order to hold margins and also grow them. Similarly, this year, while the number of days that we're reporting after the GST changes are too few, 22nd September is when it has been rolled out. But what we have articulated is that we will get down to neutralizing the impact on margins. So we will close to hold margins and thereafter FY27, to answer your question, margin acceleration should happen, all things being the same. And when I talk about margin acceleration, just to clarify, even this year before GST, I had said that we will hold margins because we want to invest in two aspects. One is technology and second is our agency business. Despite the fairly material impact of the GST changes, we are not winding down on those investments. They are investments for the future, because the easiest thing for us to do is to go slow or to retract some of the investments we need to make for the future. And we'll continue making that because this is a temporary blip.
All right, Vibha, thank you so much for joining in and giving us your views on growth going forward, the impact of GST, your outlook on margins. And we wish you and your team a very happy Diwali and festive greetings as well.
Likewise. Thank you so much, Manglam.
All right. With that, let's, tell our viewers something. As you could see when the conversation with Vibha was on and the stock price was showing, there was a money control stock score just above the line graph. Now, this is a score which is assigned to each stock, which is based on Money Control's multi-factor algorithm. It's calculated by analyzing over 40 parameters, which includes both current and historical financial statements, price charts, and the technical indicators for each stock. In fact, each of these individual parameters considered for calculation of the four factors are then assigned a score, which is then aggregated to arrive at an overall Q factor, G factor, V factor, and T factor score. Remember, this is a score and not a buy or a sell recommendation. Any investor, viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions.
Okay, all right. Well, let's focus on another earnings reaction then. Be at KEI Industries. That's the next management on the show. The stock is under pressure. The street seems to be a little bit disappointed in the revenue growth as well as the margins, though the gross margins did increase a little bit. Mr. Anil Gupta, the chairman and managing director at KEI Industries, joins us on the show. Hi, Mr. Gupta. First look at the numbers actually looked quite good. You know, the revenue growth has been quite good. So let's clear a couple of factors. Exports, they contributed a larger chunk to the revenues. So could you tell us what is the rough percentage it will contribute for this year itself, point number one? And point number two, if you could help us out, what was the domestic volume growth in your core business?
Good morning. The export growth has been substantial. It could have been more given little setback in revenue from US, but still we have been able to make up. And exports are now contributing around 17.5% of our total revenue in the second quarter. And if I see the first half, it is around 16.5%. I hope that we will be able to maintain around 18 to 19% of export of our total revenue in this financial year. We have grown by around 22% in this quarter in our wire and cable segment, because of the fall in the revenue from EPC department. We have already stated in our past several years that we are reducing our EPC business, and that is under that policy. So the overall Wire and cable revenue has grown by 22% in this Q2.
So I want to ask you, what is the volume growth in the domestic business? Exports have done phenomenally well, and I think that is margin accretive. You could correct me on that one. Exports are margin accretive. And also, what is the domestic cables and wires volume growth?
See, total volume growth in domestic and export is around 15%. You see, we have to look at the revenue in totality. We have shifted some of the capacities to exports from our domestic side because of the opportunities available there. So whatever capacities are available, we are utilizing them full, and wherever we can do better, we are shifting.
Okay. So domestic, did you lose volumes, or was it a lot lower than the total volumes of 15% because exports outperformed?
No, we did not lose volumes. Maybe 1 or 2% lower, not more than that.
Okay. So is this the strategy, sir? The strategy is going to be to ramp up exports and maintain your domestic market share. Is that a fair way of putting it?
Exactly. We are continuously ramping up exports, but while improving the domestic as well.
Got it. What about margins then? Your gross margin, there was a bit of an uptake, but other expenditure went up. Because of that, the margin expansion may not be as much as what the street expected. From here on, how do you see margins move? The problem is that commodities are going on a bit of a melt up. So in the near term, there could be some kind of impact, maybe Q3 or maybe Q4. How do you see margins pan out from here on?
I expect margins to remain between 10.5 to 11%. So far as commodity prices are concerned, copper and aluminium prices are concerned, I have said in the past also that we don't expect any impact due to that, because we are adequately covering our metal purchases and metal inventories vis-a-vis the order book.
Sir, for the full year, when we last spoke to you, you had guided for, I think, about an 18-19% top-line growth, and cables and wires at 25%. Now, considering the first half, you are exceeding that run rate. What is the full-year guidance now? Can the full-year revenues be in excess of 20%? I mean, do you have the confidence to up the guidance? And what is the second half looking like?
I have guided that our wire and cables revenues will be 20% plus. And I still maintain the same for the whole year. Incidentally, I never said that it will be 25% plus. But
apologies.
Hopefully we will we'll try to reach out there. But my guidance is 20% plus.
Okay.
Right.
And overall? So for the full year, what is the guidance? I think you had spoken about 18-19%, and in the first half, you're tracking at a 22% run rate.
Yeah, yes, exactly. So the full year, we will definitely try to aim around 20%, right. But because we are able to achieve that.
Okay. And sir, second half of the year, what is growth going to look like for you? I get the full year guidance, but if you could provide some nuance on what's happening on the ground and what we should expect.
We are seeing good demand in domestic as well as our export markets. And I don't see any letdown in our performance in the second half as well, in the third and fourth quarter. I'm sure that by fourth quarter, when our partial capacity in Sanand comes into full force, we will be able to improve our performance from the fourth quarter.
Right. We'll just come back to you. There are some visuals coming in from the listings of Canara Robeco and Rubicon Research. We'll shortly get the prices as well for both these counters. For Canara Robeco, it looks like a positive listing by about 0.5% on the NSE, and we'll get some data coming in on Rubicon as well. But you spoke about the Sanand plant. Could you give us a sense on where you stand on that as far as timelines of commissioning are concerned? Is there a delay? If yes, then what could the lost sales on account of that be?
Yeah, there is a delay of around 3 months, and we are going to commission first phase of the project by November. And but the full plant will be operational by March 27. I can't quantify that what will be the loss of revenue because of the delays, but as per the guidance, we should continue to grow by plus 20%, year after year.
So phase one that was expected in September, that gets commissioned now in November, and the entire plan that the street was working with somewhere midway through FY27. Now you're saying by the end, Q4, it will be fully commissioned, and there's no risk to these timelines, correct?
Yes, correct.
Well, always good speaking to you, Mr. Gupta. For the time being, the street seems to have expected something more on the growth, on the margins, as well as maybe a little bit disappointed on pushing up these timelines. But we take your guidance on board and wish you well. We'll keep tracking all these numbers as the quarter progresses, and wishing you and the entire team a very, very happy Diwali.
Thank you very much. Thank you very much.
By the way, this Rubicon Research has had a very strong listing. Issue price was 485. It listed at 620, now hovering around 600. And it had also seen very strong subscription in excess of 100 times, 103 to be precise, with the QIB portion inching towards 130 times. And it is one of the fastest growing pharmaceutical companies, at least in the last 2 years. The revenue CAGR was about 75%.
Even Canara Robeco, when we had management out here, they did say that the best way to look at these companies now is not as a proportion of AUM, but as a price to equity multiple. And more importantly, they do not rule out the AUM doubling from their current levels of near 1 lakh crore to about 2 lakh crore in the next 3 years, given their past CAGR.
Because AUM-wise, it's much smaller than in HDFC, Nippon, Aditya Birla and UTI AMC. So, compared to the other listed entities, its AUM at 1.1 lakh crore is much smaller.
All right, good time to bring in Vinay Rajani, who's a senior technical and derivatives analyst at HDFC Securities, joining in. Vinay, what do you make of the market right now? Do you think it's broken out comfortably above the 25,400 mark right now, closing in on that 25,450?
Yeah, good morning. So Nifty has given a rise of 850 points from the recent bottom of 24,587. It has surpassed the previous swing high of 25,448. So it is into a continuation of an uptrend. Nifty has been into overall broader consolidation, but once we get a close about 25,400, it will confirm the breakout from the consolidation which is there for last 3 months. And every time the fall we saw in last 2 months, Nifty has been able to made a higher bottom in both the instances. So it is a good sign. Broader markets are improving. Nifty has given a breakout in intraday. We are waiting for close about 25,400. But yes, we should look Nifty with the positive bias. 25,200 is the immediate support, and the next resistance for the Nifty is seen around 25,670, where we saw a swing high in the month of June. So overall, one should trade with a positive bias.
Okay, and stocks?
Yeah, so basically today we have seen some fresh buying coming in FMCG stocks. So Nestle is one of the stocks which I like on the chart. So around 1228, one can go long. 1205 should be the stop loss on the upside. I'm expecting a short-term target at 1270. The second pick I would take from the power space, Tata Power, fresh breakouts. So these both stocks have not performed in recent past, but now seems to have broken out on the short-term chart. So Tata Power around 401, one can go long. 394 should be the trading stop loss on the upside. I'm expecting a target of 415.
Thank you, Vinay, for joining in. By the way, markets building on the gap up. We open up 75 points, now up 120, the Nifty touching 25,450. But it's Diwali in the air now. You can feel the festivities. And as investors are heading into the new Samvat, there are lots of questions. Has India's dream run finally paused? Or is this just a catch-up phase before the next leg? My colleague Prashant caught up with Samir Arora, who believes the tide is about to turn. From relative underperformance to shifting global flows and the impact of rate and tax cuts, here is why Samir thinks India's setup looks stronger than the sentiment suggests.
The big picture is that there are 3 or 4 positive things right now. Number one is India has done very badly this year relative to peers, emerging market benchmarks. So over 5 years, India has still done better than EM and China and all. Maybe only US has done better. But this year, India has had its worst relative performance in 30 years, which is some 25-27% underperformance in 10 months.
Right.
That beyond a point does not last. Second is, what are the reasons why FIs are selling? I've been feeling that the world is interested currently, and not feeling that, you can see with data, that the world is putting a little bit of its global money into non-US markets. And it is not that they're doing it as a longer term play. Even currently this year, non-US has beaten US by more than 10%. So S&P is up some 13%. World, excluding US, is up some 23-24%.
Right.
So you can do it because you're upset with US policies or tariffs.
But there's performance as well.
And so it's not that
Correct.
I don't like US,
Correct.
little bit only. And so if the rest of the world is getting money, so if the US is at 65%, if they reduce 3% for US, only 2%, and give it to the 35% part of the market, for them it is 6-8% growth. In that, we have a valid claim that we should also get money. But instead, India has been losing or people have been redeeming. I think that had to do with the extra tariff and the isolation.
And hopefully
of
that
India.
also perhaps.
That I think is getting over. You can see it from the tweets. You can see it from Mr. Besant saying that they are going to change the energy basket in our favor. That is from India saying we are willing to buy corn and little bit, and then this good message that Trump sent to Prime Minister Modi, all those things, it's happening. Third is India has had a lot of interest rate cut, GST cut, tax cut. So all these things plus minus a few months has to impact. And fourthly, you can say that this year the IT guys were having very low growth. Even next year they may have low growth, but on a relative basis they're not declining more.
Correct.
And so broadly you will get 12, 13, 15% growth, and that kind of return for now is okay because your comparison is not with previous years but with debt returns or fixed income returns. And fixed income, say 8-10 years ago, used to be 9%, 9.5% for 10-year government bond. So we would say you will get 15% return in equities. Now, if that is giving 6.5, you're supposed to make 12 only.
Correct.
And I think you will make 12 kind. And then maybe following year,
Which is
IT will grow 2% more. So you'll get, maybe 15, 16%. But in general, the world, the Indian public that is, will have to realize that 20 to 25 returns were not normal.
थोड़ा normalized.
थोड़ा normalized जो है, वो पहले होता था 15ish for the index, and then we are supposed to beat it. And now the normal maybe 12 to 13, 14, maybe for some time, and then we don't know.
With some shooting stars in
And
between,
then, and then
obviously.
you get some stocks will do well.
Yeah.
Shade of green for the markets, and adding glitter to that is Titan, up 2.5% right now as we speak. Good for a second quarter update coming in. Good gold prices as well. And speaking about gold prices, Manisha joins us now. Manisha, precious metals all around, festive cheer, Diwali glitter, what do you call it?
Oh, very, very bullish is what I'm calling it, and super bullish if you want to add to that, really, because we're looking at all-time highs yet again in the market today. When you look at the last couple of months, that is where the major run for gold prices has come. So $40 an ounce has been taken off, and we are trading above those levels at this point in time. Also, when you look at the Indian markets, and MCX gold is a reference, really, so 1,28,000 rupees per 10 grams is what you have to pay, and more if you add GST and making charges to that, if you are stepping out to buy gold today. If you look at the overall price gains for this year, it is up by more than 61% for the year 2025 itself. I also want to take you through on what we've done in sense of gold prices for this current year from the very beginning. So we started this year with $2650 an ounce. And as you can see, it was a constant gain from the beginning of this year. Remember, there were geopolitical tensions and then those tariff concerns as well, which took prices to almost $3,000 in the month of March. 33 to 3,500 is where we traded between May to August. And then September onwards, it has been on fire. 37.50 in September has been a high. And for the month of October, until time, we are trading at 42.40, with the markets believing that we haven't seen an end to this run-up. And October could end much on the higher note from where we are trading right now. Well, this chart tells you on how we've moved in sense of prices from Diwali to Diwali. So if you bought gold in 2023 during Diwali, it was trading at 59,000 rupees. We've clearly doubled in last 2 years when it comes to gold prices. Last Diwali, prices were trading at 78,400. And this Diwali, we are trading at 1,30,000 rupees. So clearly, strong gains if you bought gold last Diwali and Dhanteras. Staying true to the saying that whatever you buy during Dhanteras does double up. Exactly what we are looking at right now. Silver price is exactly the same way. International prices are trading at around $53.50 an ounce. Here as well, when you look at MCX silver prices, it's trading at 1,64,000 rupees a kg. But if you step out to buy, there is a premium of 10% plus a GST and plus making charges. So you perhaps will end up paying nearly 2 lakh rupees a kg into the physical markets there. Looking at these current prices, silver also has gained up by 84% in this year. I do want to take you across on what we've done in sense of silver prices in international markets also. So we started this year with 29.5. We jumped up to nearly 33 in March. 39.5 came after many years. It was a 14-year highs when we did see 39 there, and then 45.20 in September. And as you can see, the largest of jumps have come in anywhere between August and October. $50 an ounce was an all-time high for silver, which we have crossed in October, with much higher highs being quoted by banks and brokerages as we step into 2026 as well. So look at the Indian prices now, and Diwali to Diwali is the one that you really have to watch out for. So if you bought silver in 2023, it was at 70,000 rupees. Last year was 90,000. This year, we've clearly doubled. So for gold, we've doubled in 2 years, but for silver, we've doubled just in an year. So almost 2 lakh rupees if you step out to buy there. Well, there have been various reasons that we've been quoting on why gold and silver prices are running. But the very near term clearly comes in from the Powell testimony yesterday that slowdown is threatening U.S. economy now, and 2 rate cuts going forward in this year is something that the gold and silver prices are factoring in. Apart from that, the U.S. and China trade tensions, you have ongoing U.S. government shutdown, which the markets believe that more that it prolongs, you will see more buying come in for gold and silver. And then to add to it all, it is demand for India, which is further adding premium. Markets did not think that Indians will buy at these higher prices. Remember, Indians are mostly called price sensitive, but step out in those jewelry shops and you'll see that that perhaps has been is not the case right now. People are buying.
Step out in those jewelry shops, and that's exactly what Manisha is going to do. Run away from here right now. Go to Zaveri Bazaar and tell us exactly what in real time is taking place ahead of the festivities. But boy, 2 year, doubling in gold prices in a year's doubling in silver prices. It is expensive, but who's to say when it's shining this much? Take a short break. On the other side, Lata joins in with our special segment, It's the Economy.